Jerome refreshes the app for the fourth time in 90 seconds. Friday morning, the ticker finally goes live, and there it is. SPCX climbing 170, 180, 200. He's waited 18 months for this, the chance to own a piece of the company that lands rockets like it's parallel parking. So he does what every true believer does. He hits buy. $206 a share. Feels like getting in early. Here's what nobody told Jerome. The people who sold him those shares at 206 bought them the day before for 135. Same company, same rockets, $71 cheaper, 24 hours earlier. Jerome didn't get in early, he got in last, and he paid a 50% premium for the privilege. This isn't a video about whether SpaceX is a great company. It obviously is. It's about the gap between a great company and a sane price, and why those two almost never show up on the same morning. My name is Nick, and I spend an unreasonable amount of my life thinking about why smart people lose money on exciting things. If you've ever watched a stock you love rip higher and felt that itch to just buy it already, do me a favor and hit subscribe, because today we're running the actual math on the biggest IPO in human history and figuring out what it would take for buying it to be anything other than a very expensive feeling. Quick thing before we go further, because the comment section is already typing, I am not here to tell you SpaceX is a bad company. SpaceX is arguably the most impressive engineering operation on the planet. They turned rocket launches from a national event into a Tuesday. None of that is in question. And I'm not a financial advisor. This isn't financial advice. It's just a guy who's watched this exact movie play out a dozen times, telling you how it usually ends. Because here's the thing about IPOs that the confetti and the CNBC countdown clock are designed to make you forget. An IPO is not built to get you a good deal. It is built to get the people who already own the thing the best possible price for selling it to you. That's the whole event. Keep that in your back pocket for the next 20 minutes because everything else makes more sense once you do. So let's talk about what actually happened, because the scale of this thing is genuinely hard to wrap your head around. On June 11th, SpaceX priced its IPO at $135 a share. It sold around 555 million shares and raised $75 billion. Then, the underwriters exercised what's called the green shoe, basically the bonus round where they sell even more, and the total climbed to about $85.7 billion. That makes this the largest IPO in human history, not the largest this year, ever. It blew past Saudi Aramco, which held the record at around $29 billion. SpaceX nearly tripled it. The valuation they slapped on the whole company, $1.77 trillion with a T. That number alone makes SpaceX on day one of the 6 most valuable companies in the entire United States, sitting in the same weight class as Apple and Microsoft and Nvidia, companies that have been printing money for decades. And then the stock did what hype stocks do. It opened, it popped, and within a couple of days, it was trading north of $200 a share, which is great news if you're one of the insiders who got in at 135. It's a slightly different story if you're Jerome. Now here's where the math gets interesting, and by interesting, I mean you should probably sit down. Let's look at what you're actually buying for that $1.77 trillion. In 2025, SpaceX did about $18.7 billion in revenue. That's real, that's growing, that's impressive for a company that builds rockets, but it also lost money. On a standard accounting basis, SpaceX lost about $4.9 billion last year. And since it was founded back in 2002, it has racked up a cumulative deficit of somewhere around $41 billion. So you've got a company that, despite tremendous technological success, has spent most of its history prioritizing growth and investment over generating consistent annual profits, being valued at one of the highest price tags ever assigned to anything. Let me put that valuation in terms that actually mean something. When you pay $1.77 trillion for $18.7 billion in sales, you're paying roughly 94 times revenue, not earnings, revenue. The total amount of money that comes in the door before a single cost is paid. To give you a reference point, the most expensive big stock in the S&P 500 before this, Palantir, trades around 73 times sales, and people lose their minds over how rich that is. The average company in the S&P 500 trades around 3 times sales. 3. SpaceX came public at 94 and after the pop, north of 100. You are not paying for the business SpaceX is, you're paying for the business it might become if absolutely everything goes right for the next decade. Now, to be fair, the bulls aren't crazy. If Starlink becomes the dominant global satellite internet network, if Starship dramatically lowers the cost of getting things into orbit, if SpaceX keeps winning government and defense contracts, and if entirely new businesses emerge from that ecosystem, today's valuation could end up looking a lot more reasonable in hindsight. That's the bet. The question isn't whether SpaceX can do amazing things. The question is, how much of those amazing things are already reflected in the price investors are paying today? And it's not just me being a buzzkill. Morningstar's analysts estimated a fair value substantially below the IPO valuation, arguing that investors could eventually get a more attractive entry point once some of the excitement cooled off. The IPO valued it at more than double that. Their analysts basically said out loud that investors would get a better price after the hype died down. When the suit and tie research shop is telling you to wait, that's not pessimism. That's a flashing yellow light. And here's a wrinkle worth knowing because it actually matters for the price. When you buy SpaceX, you're mostly buying Starlink, the satellite internet business. That's the part making real money. Over 10 million subscribers, growing fast with margins that look more like a software company than a rocket builder. The rockets are the show. Starlink pays the bills, which is fine, except a big chunk of that 1.77 trillion price tag is betting that Starlink keeps growing like a tech darling, and that the AI division stops setting money on fire, and that Starship, which has already consumed enormous amounts of capital and still has major commercial milestones ahead of it, turns into a real business. Every single one of them has to land, or that 94 times sales starts to look very lonely. But here's the part that makes this IPO genuinely sneaky, and it's the thing I really want you to understand because it's the mechanism that's going to fool a lot of people. SpaceX only floated about 4% of the company. 4%. They kept the other 96% locked up tight. Now, why would you do that? Simple. When there are very few shares available and a whole planet of people who want them, the price goes up. It's not magic, it's just scarcity. You've created a stampede through a single doorway, and it gets better or worse, depending on which side of the door you're on, because SpaceX is so enormous, it automatically qualifies to be added to the big stock indexes like the NASDAQ 100. And here's the thing about index funds. When a stock joins the index, every fund that tracks that index is forced to buy it. They don't get a vote. They don't get to say, 94 times sales, maybe I'll pass. They have to buy at whatever the price is because that's the rule. So you've got billions of dollars of automatic price blind buying flooding in on top of an already tiny supply of shares, which sounds amazing, right? Free buyers, here's the catch. All of that artificial demand props the price up in a way that has nothing to do with whether the company is actually worth it. It masks the reckoning, it doesn't cancel it, the fundamentals don't disappear because an index fund was forced to buy, like they just wait, and fundamentals are very, very patient. One more number on this because it's almost funny. On day one, the gap between the price insiders paid and the price the stock traded at meant SpaceX left something like $17 billion on the table, the single biggest first day pop in raw dollars in IPO history. $17 billion of value that went straight to whoever got the early allocation. And I'll give you one guess whether that was regular people refreshing an app or the institutions on speed dial with the underwriters. Now let's talk about who's actually steering the ship, because when you buy the stock, you should probably know how much say you get. The answer is basically none. SpaceX came public with what's called a dual class share structure. The shares you and Jerome can buy get 1 vote each. The shares Elon Musk holds get 10 votes each. Added up, and Musk controls somewhere between 82 and 85% of the voting power of the company, while owning a much smaller slice of the actual equity. What that means in plain English is that you are not a part owner with a voice. You are a passenger who paid for a ticket. Musk can do essentially whatever he wants, fold in other companies, change direction, pour billions into his AI venture, which is reportedly consuming enormous amounts of capital as it races to compete in the AI industry. And there is no shareholder vote that can stop him. Governance concerns were serious enough that some lawmakers and market observers publicly questioned whether investors were being given enough protection. The IPO happened anyway, which honestly tells you everything about who has the leverage here. And look, with Musk, that control cuts both ways. The man builds genuinely impossible things, but he's also running Tesla and the AI company and the social network, and he moonlights in politics, and there are only so many hours in a day. As one longtime investor put it, at this price, you're not just paying for a rocket company. You're paying $1 trillion premium for one specific human being's attention. That's a lot to ask of any one person's calendar, okay? Let me zoom out because so far this is just one company's numbers and you might be thinking I'm cherry picking, so let's talk about the base rate. What usually happens when a wildly hyped company goes public and regular people pile in? There's a finance professor at the University of Florida named Jay Ritter, and he is basically the world's leading librarian of IPO data. He's tracked thousands of these, and the picture his numbers paint is brutal. On average, IPOs underperform the broader market over the years following their debut. The exciting ones, the expensive, low float, everybody's talking about it ones, tend to do the worst. Ritter's research has consistently found that the most heavily hyped IPOs often struggle to outperform the broader market over the years that follow. The combination of sky-high expectations, limited share supply, and intense investor enthusiasm tends to create prices that are difficult to live up to, and you don't need the academic data to feel this. You've watched it happen. Facebook went public in 2012 to enormous hype and then fell about 54% over the next few months. Now, it didn't get back to its IPO price for over a year. Rivian, the electric truck company everyone loved, came public and then fell about 95% from its peak. Coinbase, 90%, Robinhood, 92%. These were not obscure scams. These were beloved, hyped, this is the future companies. And the people who got hurt worst were the ones who bought on day one because they couldn't stand the idea of missing out. Now, in the interest of not being the guy who only tells you the scary half, it doesn't always go that way. ARM, the chip company, went public in 2023 and roughly doubled within a year. Reddit came public in 2024 and ran way up. And the big one the SpaceX bulls will throw at you, Tesla. Tesla went public in 2010 and is up something like 20,000% since. If you'd bought Tesla's IPO and just held, you'd be absurdly rich. So yes, it can work. But here's the honest asterisk on Tesla, because it matters. To capture that 20,000%, you had to survive the ride, and the ride included the stock dropping more than 60% at one point, plus several other 30% plus gut punches along the way. Most people do not hold through a 60% loss in a company everyone is telling them is doomed. They sell at the bottom because that's what humans do. So when someone tells you SpaceX is the next Tesla, the correct response isn't no. It's, okay, and are you emotionally prepared to watch this thing get cut in half twice without flinching? Because that's the actual job. Which brings us back to the one idea I really want to nail into your brain. The thing this whole video is about. A great company and a good stock are not the same thing. They are related, but they are not the same thing. And confusing them is one of the most expensive mistakes in all of investing. Go back to Facebook for a second because it's the perfect parable. Facebook in 2012 was a fantastic company. Buying Facebook stock on IPO day in 2012 was a bad decision. Same company. Both statements are true. The business was excellent and the price was wrong, and the patient person who waited about 15 months got the exact same wonderful company for roughly half the price. The company didn't change, the price came to its senses, and SpaceX has a built-in reason to expect that pattern. Remember that 96% of shares that's locked up? That lock doesn't last forever. Over the coming months, in waves, big early investors and insiders are going to be allowed to start selling. And history is pretty consistent. When a flood of new shares hits the market, the price tends to sag because suddenly that artificial scarcity we talked about isn't so scarce anymore. The doorway gets wider, the stampede slows down. So let me talk to you, Jerome. Let me talk to everybody who feels that pull right now. And it's a real pull. I'm not mocking it. You watch this company catch a rocket out of the sky with a giant pair of robotic chopsticks. You feel in your gut that this is the future and you want to own a piece of the future. That instinct isn't dumb. That instinct is correct. Loving the company is not the mistake. The mistake is letting that love walk you into paying any price at all. Because the machine, the underwriters, the index funds, the countdown clocks, the thin float, the $17 billion pop, that entire machine is engineered to convert your genuine excitement into the worst entry price available. Your enthusiasm is the product. They are selling it back to you at a markup. So here's the permission I want to give you, and it's the same permission I wish someone had given me before a few stocks I'd rather not talk about. You are allowed to love a company and not buy it today. You are allowed to sit there, fully convinced SpaceX is going to Mars, and still say, great, I'll wait for a price that isn't insane. Conviction and patience are not opposites. The best investors marry them. Watching is a position. Not yet is a strategy. And the company, I promise, will still be there when the confetti's been swept up. And honestly, that knowing when to sit on your hands is the single thing I get asked about the most. People message me some version of, okay, Nick, but how do you actually wait when everyone around you is buying? That's a big part of what we work through inside our school community. A group of people learning to think about this stuff clearly instead of emotionally, sharing the research and talking each other off the ledge when the hype gets loud. If that sounds like something you'd want, the link's in the description. No pressure, it's just a good room to be in when a moment like this one comes around. Now, the diehards will say, Nick, if you wait for the perfect price, you'll wait forever and miss the whole thing. And that's a fair worry, but notice I'm not saying wait for perfect. I'm saying don't pay obviously historically, mathematically insane. There's a giant canyon between buy at any price right now and never buy. That canyon is where smart investors actually live. You can dollar cost average a little over time. You can wait for the lockups to clear. You can buy a low cost index fund that, by the way, now owns a slice of SpaceX for you automatically without you paying the day one tourist tax. There are a dozen sane doors into this. The hype is just pointing at the one with the highest cover charge. So where does that leave us? SpaceX is a staggering company that just pulled off the biggest IPO in history at a valuation that requires a near flawless decade to justify, with a structure that gives you no say, a flood of shares waiting to be released, and 100 years of market history quietly suggesting that the people who buy hyped IPOs on day one usually wish they'd waited. None of that means the company fails, it just means the stock at this price on this day is a bet against some very long odds. As for Jerome, he's fine, by the way. He didn't bet the house. He bought a few shares at 206 because it felt like the future, and maybe in 20 years he'll be right and I'll look like an idiot. But if SpaceX really is the company we both think it is, then it'll still be worth owning at a fair price 6 months or a year from now. And Jerome will get a second chance at a first move, this time without the 50% surcharge for being excited. Because here's the last thing, and then I'll let you go. There is no trophy for buying first. There's no medal for catching the top of the pop. The prize in investing doesn't go to the person who's earliest or loudest. It goes to the person who's still standing, still calm, still buying good things at fair prices long after everyone else has moved on to the next shiny rocket. Be that person. Watch, wait, run the numbers, and let the confetti settle before you decide it's a party worth paying for. If this helped you think a little more clearly, the community link's down below, and I'll see you in the next one.